All right, perfect. Hopefully y'all can hear me. Right, so as Wenxing said, this is joint work with Zhang and Rob. And since I'm at the Federal Reserve, the usual disclaimer is going to apply. So today I want to talk about global imbalances. These are, large differences between foreign asset and foreign liability positions, both in the US, but they've also grown in other developed economies as well. Now we know from the literature that these imbalances, they are driven by both changes in quantities of assets being held by investors and also changes in price adjustments through valuation effects. Also, the literature has suggested a number of potential explanations for why these large imbalances have grown. For example, there's narratives about savings gluts in the sense that investors in many parts of the world, they have an excess of savings with respect to domestic investment opportunities. So these savings go off into the world and invest in places like the US. There's also narratives about official holdings. For example, maybe you're thinking after the East Asian financial crisis, emerging market economies, their central banks started purchasing a lot of US dollar denominated debt. And then so there's an increase of US liabilities abroad. And also there's stories about demand shifts in individual investors' demands. For example, narratives about flights to safety, shortage of safe assets in which investors really want to now invest in US or other developed market assets. Now, there's also many challenges to this literature. In particular, up to this point, there's not really a quantification for how much these various forces seem to matter overall for the change in the US net foreign asset position. Moreover, typically in this literature where the methodology is to run regressions of capital account variables against other explanatory variables, we don't fully take into account the full substitution pattern that investors have both across asset classes, within asset classes, or also of potentially bilateral drivers of flows. In particular, so in a world where the demand curves for assets is not perfectly elastic, it's really important to get right the endogeneity, the relationship between capital flows and asset prices. In other words, as assets come into a country, we do expect the prices of these assets to respond endogenously and increase. So these are the problems that we're going to try to tackle in this paper today. We're going to start off by estimating a demand-based asset pricing model, largely based off the work by Ralph and Moto. And we're going to do so to try to understand long-run variation in US external portfolios. We're going to build on this literature by allowing for endogenous wealth dynamics. In other words, we're going to try to introduce a way to allow for the endogenous adjustment of wealth to other components of demand systems so that wealth responds to returns and changes endogenously over time. Afterwards, we're going to conduct some counterfactual analysis that attributes these changes in US portfolio imbalances and asset prices in the last 20 years to narratives that look like savings gluts, official holdings, and shifts in individual investor demands. All right, so what are our main findings? So the headline number from 2002 to 2016, we can observe that the US portfolio imbalance widened from negative 10% of 2002 GDP, that's a negative $1 trillion US, to negative 32% of 2002 GDP. So widened by about $2.5 trillion. Looking at the global savings glut alone, so changes in investor savings relative to issuances, is going to suggest that US portfolio position should have declined by up to negative 76% of 2002 GDP. This is vastly overshooting what the data shows. The vast majority effect is we're going to see is going to come from growth in developed market savings rather than emerging market savings. We're going to be able to show that official holdings, so foreign central bank purchases, are also going to widen the US portfolio position to an additional negative 94% of 2002 GDP. Interestingly here, official holdings, they're mostly in the debt asset market. However, central bank purchases of debt assets are also going to have significant spillover effects to equity prices and holdings because we're going to allow for cross-asset substitution. Finally, we're going to look at demand shifts. And these demand shifts, changes in demand curves of individual investors are going to reverse this negative 94% back to the 32% that we see in the data. Much of this reversal is going to come from a shift away from debt markets and towards equity markets. And in particular, this is a kind of a surprising result, right? Because if you think about all the common narratives, it's that people and investors are demanding more US asset. But once we do this decomposition and take into account these other stories, it really seems like investors are shifting away from US assets. So if I can take a step back here and just give a more general takeaway, it's that, if we look at this underlying pretty simple trend, this widening of the global imbalance in the US, it's actually represented by a lot of opposing forces that we really need like some kind of structural model like the one that we have here to fully disentangle. And that's what I want to show today. So with that in mind, I'm going to move ahead. I want to start off by giving you guys a model overview. All right. So the model as a whole is going to be a little bit involved. So before we jump into all of the equations, I want to give you guys a sense of exactly where we think. Should I be responding to these questions or no? By the way.
We'll stop.
So yeah, if it's like a clarifying question, sometimes we'll take natural pause to ask. Yeah, and sometimes the co-authors can also type it online. But in this case, yeah, it's our first question and you saw it. So why don't we go ahead to answer Pierre Olivier's question? So I'm gonna read it because it's only to the panelists. So the question is, what does the decomposition in Q imply for the decomposition in P? For example, is it risk premium, global real rates, etc.?
Yeah, so within this demand system framework, so any movements in Q are necessarily going to generate movements in P. Now we don't necessarily then have a direct decomposition from whether this change in P is going to come from risk premium by itself or changes in real rates yet, but that is something that we could tackle later on. And we're going to have I'm going to have a slide in like when we get to these results that are exactly going to show you a decomposition of prices versus quantities. So to illustrate this point. Yeah, so great question, thanks. Yeah, all right, so let me move on. Let me just give you guys a brief overview of what our model is going to try to suggest. Essentially, we're going to set up the structural model of international asset markets. The specification of demand curves is going to largely follow Koijin and Yogo 2020. What that means is that we're going to have a bunch of investors in this model, and these investors are going to have demand for different types of assets. These demand curves, they're going to allow investors both to substitute between assets of different countries. So for example, purchasing US debt or purchasing Japanese debt, but also they're going to allow for investors to purchase assets of different classes, so debt versus equity. Importantly, we're going to modify the wealth equations and the market clearing conditions in the model so that the AUM of investors is going to evolve endogenously over time. And that's going to allow us to study these long-run dynamics and portfolio holdings. We want to think about, in our model, exchange rates responding endogenously to capital flows. So we're going to allow for endogenous exchange rates that are going to clear debt markets. And moreover, we want to think about a role of monetary policy. So monetary policy is going to affect two things in the model. One, we're going to take short-term interest rates as policy variables, so they're going to be given. And then we're also going to think about official reserve holdings. So we're going to be able to observe what central bank reserves hold in terms of asset quantities, and we're going to be able to try to play around with changing these as well. All right, so with that in mind, let me get started with the model. There's going to be N countries in the world. They're issuing assets in 3 different asset classes indexed by L. These asset classes are going to be short-term debt, long-term debt, and equity. Each asset class is also going to contain some sort of outside asset indexed by N equals 0. And you can think of this outside asset as just like any short-term debt that's not being issued by one of these N issuing countries. We're going to take quantities Q. They're going to be exogenously given. they're going to be the quantity supplied of each asset N. And also delta Q, the changes in these quantities of assets are also going to be taken exogenously as well. So if you're thinking about what's the quantity of assets out there, QT plus 1 is equal to the quantity that were issued yesterday plus some exogenous issuance, delta QT. Just a brief note here, the Q, because we're often going to be thinking about prices of assets as market to book ratios within our framework, Q you might want to be thinking about already as a book value of an asset. There's going to be I investor countries in the world where representative investors are allocating AUM-A over all these available assets to purchase, N assets, as well as the L asset classes. So now let's talk about demand. We're going to model demand using a nested logit structure. What this W means, the weight that investor I puts into asset N in asset class L is going to be a product of a within asset class portfolio weight, as well as an across asset class portfolio weight. The portfolio weight within asset class, so investor I investing in this asset N, in this asset class L, is going to be logit, where this delta sort of captures like a desirability for investing in this asset N in this asset class L. What is this delta? This desirability of investing in this asset is going to be an exponential function of some expected return the investor expects to get from investing in the asset. It's going to be a function of the characteristics of this asset, as well as some latent demand term kappa, which is going to capture desire for unobserved characteristics, unobserved components of this asset. So you can see that how much investor invests is going to depend on the desirability of the asset she's investing in, as well as desirability of all the other assets out there within this asset class. Now, the really important variable to kind of take notice of here is this mu term, this expected excess return. Essentially, this expected excess return is how we're going to try to introduce asset prices and exchange rates into this structural model. The expected excess return is going to be a linear function of the prices of the assets, as well as the real exchange rate between country I and country N. Essentially, what we're going to do then is we're going to first run a forecasting regression of dollar excess returns to try to figure out how do dollar excess returns relate to prices and exchange rates. And then we're going to construct this mu using this forecasting regression as a linear function of the prices of the assets, the short-term interest rate in country N, as well as the exchange rates between country I and country N. That's essentially what I want to say about that. Afterwards, we want to think also about demand across asset classes. We want to allow for investors both to invest in Japan versus US, but also debt versus equity. And essentially, this outer shell, this outer is also going to be logit in structure. Investor I's portfolio weight in asset class L is going to depend on the sum of this desirability of all those assets and within each asset class, as well as some asset class specific fixed effects as this Xi term, which we're going to think about as, again, latent demand, demand for unobserved asset characteristics. You're going to see these lambdas here. These lambdas here are going to govern the elasticity of substitution between asset classes. Essentially, we want these to be between 0 and 1, such that as the assets within an asset class become more expensive, you're going to try to shift away from that asset class. All right, so the last equations that we're trying to think about here are central banks, AUM dynamics, and market clearing. So central banks are pretty simple. In each period, there's going to be central banks in each of these investor countries. They're going to hold an exogenous quantity B of the country N assets. We're going to take these Bs, these quantities of assets being held directly from the data. The AUM of an investor is going to evolve in a very natural way. The AUM today is equal to the AUM yesterday multiplied by the portfolio weights. So we get the holdings yesterday multiplied by the return that the investor gets on those assets plus some exogenous savings, F. The important variable in this AUM component here is going to be this return variable, where the return on investing in any asset is going to be the change in the prices plus any dividends that the investor is going to receive. Now, if you're looking at this equation, you might be wondering, what are these S's doing here? As I've kind of said already, for equity markets, we're going to try to think about prices in terms of market to book ratios. So the S's are just going to be a small adjustment to get those market to book returns back into dollar price returns. All right. Importantly for this return variable is that in this structural model, prices are going to be endogenous. So again, as capital flows into the country, prices are going to move up. That's going to change then the return that investors are receiving on their investments over time. And as these returns change over time, that's going to then feed back into changes in AUM over time. It's going to shift the wealth across countries as well. Now, at each given date T, we're going to have a market clearing condition in which the total supply of assets in dollars must equal to the total demand for those assets being held by private investors, as well as the assets being held by the central banks of each country. All right, so with these equations in mind, we can now go and conduct our empirical exercise. And this is the outline for the exercise. So first thing we're going to do is we're going to estimate parameters for within and across asset class substitution. And this is going to allow us to derive demand functions for each investor I. Second, afterwards, we're going to use the market clearing condition on the last slide to perform counterfactual exercises. And essentially, we're going to take asset issuances, savings, dividends, holdings, asset characteristics, as well as short-term yields as given, as well as the parameters that we estimated in the first stage as given. So these are the exogenous components. We're going to move these around, and we're going to use the market clearing condition to solve for endogenous vector of exchange rates. The exchange rates are going to clear the short-term asset markets. We're going to solve for a set of long-term debt yields that are going to clear long-term debt markets. And we're going to solve for the endogenous market to book ratios P that are going to clear the equity markets. All right. Of course, because there's all this cross-asset substitution, essentially we're solving for this full vector of exchange rates and prices all at the same time. So we need two types of data for this exercise. We need portfolio holdings data, and we need data on asset characteristics. Portfolios holding data, we're going to observe from the CPIS. These are going to be annual portfolio holding data by investor, issuer, and asset type. So an example is given here. US held about $900 billion of German equity at the end of 2014.
Sorry to interrupt, Tony. Before we go to the data, we have another clarifying question from Charles Engel. So the question is, so does a French person's demand for US bonds depend on the same variables as Canadians? What are the units of rate of returns for the two?
So the first question, these things are, the yields are going to be annualized, of course. And in short, yes. So the characteristics of the assets themselves, if we're going to go back a few slides, these X's are going to be the same across all investor countries, okay? The things that are going to be different, for example, is this expected return component. So the expected return of investing in a US asset for the Canadian is going to depend on both what is the dollar return in the US, but also on the Canadian-US exchange rate. Whereas for Germans, it will be the expected appreciation of the US Euro exchange rate. So there will be differences for investors in that sense. In various forms of the model, you can also introduce more heterogeneity by having different parameterization of these theta, so different weights on the characteristics across investors. But that's not something we have done so far in this framework. All right, hopefully that was clear. Okay, so moving on to portfolio holdings then. Shockingly enough, or perhaps unshockingly, we spent an incredible amount of time looking at this portfolio holdings data relative to all the time we spent on this project, I think. These investors, again, these are going to be private investors from the CPIS. They include banks, corporates, households, and governments. But the CPIS excludes central banks. So we're supplementing the CPIS with another IMF survey called CFR. And the CFR data basically is going to give us an aggregated foreign reserve holdings by issuer country, but doesn't split things out. So we know that on aggregate, central banks held some US debt, but we're not saying that like Chinese central banks held US debt. That's not observable to us. We're also going to use the US Federal Reserve domestic holdings. We're going to use Federal Reserve balance sheet. That's going to give us information about domestic holdings so we can evaluate the effects of, say, quantitative easing. Now, there's also two other challenges with using CPIS that I want to briefly mention. One, Coppola, Maggiore, Nyman, Schrager, they have shown essentially that the CPI's holdings, a lot of these things are going to be in tax havens. And then so if you just take the raw CPIS, these financial holdings in tax havens can present a pretty distorted view of reality. So a concrete example is like a lot of times you're going to see the US investing in the Cayman Islands, but in reality, it's like the US investing in the Cayman Islands, and that's really an investment in Brazil. So we want to think about the investor as having in mind US investing in Brazil and not US investing in the Cayman Islands. We're going to try to correct for this a little bit, or as much as possible, basically using the CMNS reallocation matrices. So this is their global capital allocation project, where they provide matrices that try to redistribute the holdings in these tax havens back to a nationality basis. There's another issue where a lot of EMU investment runs through Luxembourg. So if you look at the raw data by itself, you're going to see that Luxembourg is a top 10 investor in all asset classes. So our goal there, basically, we can't really split up the Luxembourg investment back to its origins. So we're going to combine all the European Monetary Union countries into a single investor, and then just take the investment decision of EMU as a whole. The CPIS also does not observe domestic holdings. So we're going to estimate domestic holdings basically by subtracting foreign holdings from total market capitalization data. This is for debt and equity. Equity, we can use data stream. Debt, we can use BIS, plus some additional RA grunt work. All right, so we also need some asset characteristic data. We choose assets and issuer level characteristics that should hopefully be useful for predicting expected returns. These are going to include variables that the currency risk literature has pointed out to as useful for predicting expected returns, like GDP per capita and trade centrality. Also variables that capture macroeconomic risks, so things like inflation, sovereign default probability, trade exposure, distances across countries, market volatility. As we mentioned before, we need some notion of asset price. So for equities, we're using the market to book ratio at a country level. For bonds, we're using 10-year government bond yields annualized as well. And for long-term debt, we're using 10-year government bond yields. Short-term debt, we're looking at 3-month government bond yields. So ultimately, what do we have? We have 43 investor countries. 36 of these countries are going to be issuer countries as well. And our data ranges from 2002 to 2016. Okay, now we get to estimation. So this nested logit structure is really useful because it yields a lot of convenient estimation equations. Two convenient estimation equations. The following equation here is what's going to allow us to estimate demand within each asset class. All right, so you can see that's basically the log ratio of the weight that investor I puts into in country N divided by the weight that she invests in the outside asset. Is just a linear function of the expected return she expects to receive for investing, plus this linear function of the characteristics of the asset I, as well as kappa, this latent demand term. This latent demand term, you can kind of see already, it's going to pop out as basically the residual of a regression. Now, if you're looking at this regression equation here, you can already identify a econometric problem. Essentially, this beta is going to be biased downwards. Why? As I keep mentioning, capital inflows to drive prices up, expected returns kind of go down. So you're likely to see a negative relationship between expected returns and the weight that investors put into an asset. and that's not great. So within this iteration of the paper, what are we doing? We're going to follow a procedure suggested by Ralph and Madel in their work. We're going to use the structural model to construct a set of implied instruments. What we do is we estimate this equation 8 using only the characteristics that we really believe are like definitely exogenous to this demand system. So things like GDP, distance, investor fixed effects, and own country dummies. All right, these things are not going to respond, not likely to respond to these endogenous capital flows necessarily. Once we estimate equation 8, we're going to use the structural model to construct a predicted exchange rate and a predicted price. And we're going to use these predicted exchange rates and prices to instrument for expected returns in this regression instead. Essentially, we're trying to use the variation of these exogenous components of the demand system to instrument for these expected returns across these countries. All right. I wanted to mention one more thing that brings us back to Engel's earlier question. It's the fact that because distances are within this set of characteristics as well as trade flows, there will be a couple of bilateral components of, as I said, there will be some sort of bilateral components of demand. So again, also not only is Canada and Germany, they have these different expected returns, but they also trade differently with the US, and they also are different distance away from the US. All right, just want to clarify.
We also have a question from Pierre Olivier. He wants us to think more about the instruments. So can you say a bit more about, for instance, what are the variables exogenous to capital flow here? In a sense, like what justifies for this instrumentability?
Yeah. Essentially, what you're really worried about, right, is that variables that are endogenous to capital flows, they're responding to the capital flows and they're biasing the results. First of all, just within the structural model, by assumption, all right, just by assumption, we're assuming that the characteristics that are involved in this X are going to be exogenous variables, right? And really, we can choose. We're really trying to choose a subset of these variables that are most exogenous as possible. So distance, we don't expect capital inflows to change the distance between countries. All right, so these are variables we think that are most likely to be exogenous, and we're going to try to use this variation to try to construct our instrument. Now, it is true that if you keep writing more involved macroeconomic models, capital inflows may then have influences on other things that we're taking as exogenous, things like inflation, GDP per capita, and this like. And ultimately, at some point, we would, of course, love to build structural models in which all these variables respond endogenously. But for the moment, we're not there yet. And so this is why within this framework, at least, we're taking these variables, we're kind of assuming that they are exogenous. But we should also say—
Follow up, yeah. So can an instrument be in the X variable already?
So the instrument itself is going to be the predicted prices and exchange rates, but they're going to be taken from, yes, these X variables. So for example, investor fixed effects, distance, they are X variables, and we're going to first estimate equation 8 using those variables only. So not using the prices or the endogenous variable. We're going to use only distance and investor fixed effects here, and then construct these predicted E's and P's. Okay, hopefully that's clear. Maybe it also clarify things to see what they do. So to give you guys a sense of what comes out of this kind of estimation procedure, essentially what the left-hand side here is going to show is these are the selected coefficients that come out of these regressions. We're estimating this equation 8, this within asset class demand, class by class, short-term debt, long-term debt, and equity. The first thing you're going to see is that investors exhibit downward sloping demand curves. Okay, what does that mean? You can see that as expected excess returns increase, investors do seem to want to shift their portfolio weights towards those assets. However, this elasticity of substitution is not going to be constant across asset classes. Equities are less substitutable than debt across countries. So it seems like when you expected returns increase more in these debt markets, there's going to be greater shifts of capital relative to the equity markets. You're going to see that characteristics that capture currency risk premium are indeed desirable, things like centrality, size. And you're going to see that if you look a little bit more closely at the instrument, that at the very least, the IV regression results do seem to increase the coefficients on ERX. All right, so if you look at the OLS regressions, they're going to all of these coefficients are just going to be a little bit lower. So that at least gives us some confidence that something is going in the right direction here. The last thing I want to say about our estimation is that across asset substitution also delivers pretty sensible results in the sense that coefficients that are supposed to be between 0 and 1 are so. Again, just to, there we go. So I think that with these regression results in mind, I want to move forward and talk about our counterfactual exercises then. Okay, so US external imbalances. From 2002 to 2016, the US portfolio imbalance widened from negative 10% of 2002 GDP to negative 32%. This is the number I gave you before. Here's the plot of the data, the raw data. You can see that this orange line, this is the overall net portfolio position. It's mainly being driven by long-term debt. All right, this is the decline of long-term debt. As we've mentioned before, and it has been mentioned in other papers, the US holds a positive equity imbalance, and this remains true in our data as well. We're going to take this orange line, and we're going to try to decompose it. We're going to start off our counterfactual analysis by setting investor asset issuance, central bank reserves, demand, all these exogenous variables back to the 2002 levels. We're going to set savings to cancel out any dividend payments. And basically under these parameters, all counterfactual holdings, asset prices, and their exchange rates are going to converge to their 2002 level. You can see now why we're also always normalizing by 2002 GDP. So at the end, we get this nice flat line. This is our baseline. What we're going to do now is we're going to iteratively feed data for the exogenous components back into this structural model, and we're going to move slowly from this red line back to this orange line. Now we're going to start off with global savings gluts. So we can see in the data that from 2002 to 2016, the total AUM in our sample of investor countries increased from $60 trillion to $148 trillion. The shares of this debt outstanding, so the supply of assets, also increased dramatically. So if we allow for the increase in savings along with the increase in supply together, that's going to move this red line down to this blue line, which we're going to call the savings glut counterfactual. You can see then that these trends dramatically widen the US imbalance from negative 10 all the way down here to negative 76%, greatly overshooting what's actually observed in the data. If you dig into this a little bit further, what essentially you're seeing is that non-US private investors, they're increasing their savings and they're really purchasing a lot more US assets. And so the US liability position is increasing, in particular in debt markets. Now, I mentioned this to Pierre-Olivier a little bit earlier. I want to come back to this a little bit, is that within this framework, the prices and quantities are, they're endogenous outcomes. So this decline in the US portfolio position that we're showing you right now, it's reflecting the total changes both in the quantity of assets that are being held by foreigners, as well as the necessary changes in price that are required to clear financial markets. So as investors bought more US debt, this dashed line plots what would have been the counterfactual portfolio imbalance, but at 2002 prices rather than at the counterfactual prices. You can see that a lot of the widening just comes from the fact that investors abroad are purchasing US assets. But then also the additional price adjustment is going to capture is going to increase this portfolio imbalance to this final straight blue line here. Good. All right. I want to make sure that point is clear.
We have a couple of clarifying questions from Moto and from Madel. You guys can just unmute yourself to ask if it's easier.
Mine, I think, was already answered in the chat, but I'll say it aloud just in case the audience is wondering the same. I asked whether this was total savings or this was a foreign portfolio investment. Just what the notion of savings is here.
Yeah, so this is okay. So yeah, it says already answered in the chat. This is portfolio so this is from the CPIS. This is total portfolio savings from the CPIS, basically encompassing the savings of all the private investors. We're going to talk about
save domestically, right? Because we're going to have domestic holdings. So it's not just the foreign portfolio, but it's anything that you would observe in long-term debt, short-term debt, and equity within.
Right. Yes. Yeah.
But it wouldn't have like deposits or anything like that, if that's what you're getting at.
Yeah. If it's not, it wouldn't have deposits. Yeah. Okay. And it also wouldn't have central banks, depending on what you're getting at. Yeah. Right. Okay.
Moto has a question, right, regarding the valuation.
Oh, yeah, just a quick clarifying question. These are inclusive of changes in prices as well. So you could further decompose it into how much is coming from valuation effects versus actual changes in positions.
Yeah,
right?
So that's absolutely correct. So we're trying to show this here with the dashed blue line that if we had the same positions, but we tried to use the 2002 prices, that's going to be represented by this dashed blue line here. The solid blue line is inclusive of both. Mm-hmm. And of course, yeah, so in some of our future work, we definitely want to dig a little bit deeper into those. The second remark I really want to make here is that the vast majority of the effect of private savings gluts, so private savings gluts, is originating from developed market economies and not from the EM economies. So emerging market AUM, you can see in the data from the CPI data at least that they're increasing from 1.7 to about $14 trillion. And this is huge in relative terms, but it's absolutely dwarfed by the increase in savings or the market AUM from the developed market economies, which grew from $57 trillion to 125. And as we can see, we're running the counterfactual here. The green line is what happens if you only allow the EM, the emerging market economies, to have their AUM grow according to the data. And the blue line is what you do get after you add in both EM and developed markets. Now, of course, I have to, again, mention a caveat. The CPIS does not capture the official holdings. And we kind of suspect that a significant portion of emerging market holdings are from official central bank reserves, which we're going to tackle on the next slide. So official holdings. Our data captures two forms of official holdings so far. They capture a large buildup of foreign central bank reserves as an aggregate, but also from Federal Reserve quantitative easing purchases. And we can show that these policies explain an additional 18% decline in the external imbalance. So that's moving from the blue line now down to the purple line. Essentially, the force that is dominant here is that foreign central bank purchases of US debt, they're worsening the US external position. In other words, a lot of these foreign central banks, they've increased their position in US debt in recent periods. And this is, of course, partially offset by Federal Reserve quantitative easing, but not exactly. Now, central banks are mostly active in debt markets. So this next result is a little bit shocking, I think, is that first, we should note that in the data, they don't even break into the top 10 investors by AUM in equity markets, all right? However, if you look at the decomposition between debt and equity imbalances, you can see that there's a significant effect on the US equity imbalance from these official holdings. Essentially, in the debt market, you get a picture that's very much like the overall position. But in the equity markets, moving from the blue line to the purple line, you can see that these central bank purchases, they're driving investors away from debt into equity markets, and in particular into equity markets outside of the US in relative terms. So what we got from this picture essentially is that if we want to understand the role of central banks in official holdings, cross-asset substitution is absolutely crucial for quantifying this role. In particular, thinking about how investors might want to, say, look for better investment opportunities as the prices of developed market debt get bid up. All right, so the remainder of this exercise, the remainder of the gap between official holdings and the demand shifts, they're really going to, and the data is going to come from changes in investors' demand. So demand shifts, they capture changes in allocations, both basically from observed and unobserved characteristics. Okay, so it could be the idea that investors are shifting their demand because some countries are growing. So like Brazil is growing over time, and if Brazil is growing over time, it becomes a much more viable country to invest in, and so you see more capital flow towards Brazil. It could also be coming from these latent demands terms, these kappa and these xis, which are basically capturing demand for unobservable asset class or asset-specific characteristics. You can see then that in a bit of a surprising result, contrary to a lot of these standard stories of there being a flight to US safety, changes in demand curves suggest that the relative desirability of US assets is actually decreasing. See, we have this overshooting effect when we take into account savings gluts and official holdings, but this reverses and gets us back to this orange line once we think about changes in investor demand. Where is this coming from? So in order to try to dig a little bit deeper into this result, we try to look at both changes in characteristics. We looked at changes in the latent demand terms for both within and across asset substitution. And essentially, what we're seeing here, the overwhelming effect seems to be a shift away from debt asset markets and towards equity markets. What I'm plotting here on the left-hand side is AUM weighted version of the xis. These are demand for unobserved characteristics across asset classes. You can see that the trend here seems to be that from 2002 to 2016, there's a huge decline in the willingness to invest in debt asset markets. It declined a lot. Then the financial crisis hit, and so everyone wanted to invest in debt again. But then, since the financial crisis and since everything's calmed down, we're again shifting away from debt. So because everyone is shifting away from debt, this asset class in which US holds a large financial liability, so a negative portfolio imbalance, and towards equity, where the US is holding a positive imbalance, these things kind of average out. And so it looks like, as a whole, people are shifting away from investing in the US. Now, this shift in demand could, again, potentially be consistent with a number of stories out there, including potentially reaching for yield story. Okay. All right. So that was the last picture that I wanted to show everyone. I'm going to end a couple of minutes early, but let me conclude. Essentially, what we tried to do here is we tried to adopt this portfolio approach, this structural approach, to examine the decline in the US external portfolio position in the last 20 years. Now, what we tried to show, or we have shown in the pictures, is that savings gluts and official holdings, they're kind of moving the right way. They're contributing to this widening of the US portfolio imbalance. Whereas, perhaps counterintuitively, demand shifts seems to offset some of these effects. Now, in a standard approach, these countervailing forces are not going to be observable in the raw data. So in this sense, we think that this speaks to the strength of using this kind of structural approach to try to understand this external portfolio position. And of course, so a number of things have been brought up already, but we do think that this, taking a bigger step back, we do think that this structural approach has a lot of opportunities to dig a little bit deeper, say, at the valuation effects and trying to understand those versus the shifts in quantities, trying to understand phenomenon like exorbitant privilege, as well as phenomenon such as the separate roles of, say, emerging market versus developed market official reserves. All right, with that, thank you very much.
Great, thanks so much, Tony. So now let's open up the floor for Q&As. You can either raise hands or type in your name or questions in the chat function. I guess we can start with Pierre-Olivier first.
Yeah, hi everyone. This is a very interesting paper. It's very intriguing. A couple of questions. So first, I suspect you can do a decomposition of returns into the component that comes, or excess returns, risk premia, whatever, the component that comes from savings glut versus central bank accumulation versus shifts in demand, just like you do it for quantities. This was the sense of my first question. You know, if I look at it from the return side, what do I see there in terms of the movements in the, say, the short-term risk-free rate and versus expected equity returns or measures of risk premium? You can certainly tell us something. And that would be interesting to complement the quantity data. Then the second thing, I must say, I'm still not sure I understand your instrumentation. It sounds like you're using some of the X variables for the instrument, but then you're not putting them in the second stage itself. Something I'm not understanding. But that's not. I should read the paper. I guess the more substantive question in terms of your decomposition, if you can show us the decomposition, the last one with the one yeah, exactly. So it sounds like you have observable and unobservable changes in demand. You're showing us basically a residual here. You're saying, here's what I need to get back to the data. And so that includes both the observable and unobservable. And in particular, it includes any error I would have made in constructing my savings glut or official holding impact on quantities that would be lumped into the unobserved demand component. I wonder if you could show us the sort of the observed one. And maybe we can discuss that one, because at least that one we sort of understand what it is. The rest is something that is both an observed demand plus any estimation error, I think.
Yes, so you're absolutely right. Yeah, so let me tackle, okay, so one of the things I want to say, first of all, is that just to bring up, you're talking, you wanted us this one thing tackle the effect of these various changes, these stories on say components of returns. And I would just like to say that, you know, this Ralph and Modo paper that I keep pointing to, that I've alluded to a number of times in this paper, that's kind of exactly what they do. They kind of introduce this sort of a structural model, this framework to try to understand the returns on assets and exchange rates over time. And so in particular, one of the reasons we're focusing on quantities right here is we're not taking on that problem. That's a problem that they've kind of already tackled. So of course, yes. So we do have some decomposition, and our structural model also has some additional implications for what are changes in returns, but we're not exactly focusing on that in this paper here. And that's basically the reason why. In terms of what's happening with observed characteristics and unobserved characteristics, with the I unfortunately, I don't have that figure with me. There is some movement based on observed characteristics that we do see. So you're absolutely right in the sense that those are things that we kind of can explain, but a large portion is indeed coming from these unobserved characteristics. And so one of the things that we do want to tackle next is indeed digging a little bit deeper to figure out, you know, where is it coming from, whether it's model misspecification or whether we can chip away at that a little bit more. It does remain a problem.
Let me add one thing here to what you're saying. I think you are right here, Pierre-Olivier, that moving between this purple line here and the orange line would be incorporating anything that we're missing in changes in portfolio weights over time that is misattributed to changes in, say, well, sorry, the blue line effectively, I think, is where it mainly shows up, because we're computing the flows off backing out of this AUM evolution equation. So, right, any estimation error there would effectively show up in this gap. I think you are right in that sense. So we should think about that a bit more.
In terms of the estimation error, I also want to add one thing in response to Pierre-Olivier. So here's one way to think about the savings glut counterfactual, this blue line. So to start, let's think about the counterfactual case in which you just allow people to have more money to save, and they keep their portfolio weights into different assets, debt and equity constant. That would tell us how the portfolio imbalance of the US would have changed in that counterfactual scenario. And what we do here is to build on top of that and allow the portfolio weights to endogenously adjust. So if one asset gets more expensive, you will have the agents to decrease their holdings of that asset. So basically, by combining this endogenous aspect of the demand system, that's how we derive or arrive at this blue line, suggesting that the savings glut contributes to more than what we see in the data in terms of portfolio imbalance. And in that sense, we might be able to derive some error band in terms of how much we miss by deriving a 75% of the imbalance here in the blue line.
Great. So there's Charles has a question about,
okay, I will, sorry. Yeah, thanks for answering that question so early. I guess we can now go to our next question. How about you, Moto? You want to ask your question?
Yeah, actually, I wanted to maybe add to the response to Pierre Olivier's question. So my understanding of the paper is, so there's two steps, what they call savings glut, and the third step they call demand shift. So conceptually, the way to think about the savings glut is if you save additional dollar, where does it go? Holding demand curves constant at their estimated values in 2002. And then the third step accounts for changes in portfolio rules over time as the relative riskiness or attractiveness of countries change over time. So I think conceptually, like that's what they're doing is, if you had the same portfolio rules as you had in 2002, but you just had the world save more, then where does the dollar go? That's the first step. And then the third step is, how does the composition of how that dollar is invested across countries changing over time? So those are conceptually two different steps in their decomposition. So I guess the question I had, which relates to this, is the key coefficient in the demand function is the specialness of the dollar, which is captured by a dummy for US assets. So if we go back to the first step in the decomposition, where what they're calling the savings glut, what baked into that savings glut experiment, I think, is the fact that foreign investors prefer US assets. So when you throw in more savings, then that goes to the US, because US is a special country. So then that's how I think you get these trends coming from the US dummy in the demand function. But I wanted to understand maybe better, maybe the authors could do this, is like how much of the first step savings glut trend is coming from just this US specialness dummy versus something else. So.
You're exactly right there, Moto. We have it as it's not a US year fixed effect, but it is just the US year. So you're exactly right that any increases in savings there would be taking into account the demand that there is specialness of the US dollar. Yeah. It's a very good point. So I think we should look at a version of this where we don't have that in the demand curve, or at least decompose how much of this comes from the fact that increases in savings do lead to specialness of the dollar, because you guys have shown, of course, in your work, right, that there's a large effect on prices from that as well. So
yeah, essentially we would just have to turn off that dummy, right, and rerun the counterfactuals. But that's a really good suggestion. We'll do that. Yeah,
I'm thinking like a lot of this action you get in the first step must be coming from the specialness dummy. But that would be good to understand, I guess.
For sure.
Yep.
Great. Now let's ask Johan to ask the next question.
Me, right? I assume Rohan, you mentioned?
Yeah, Rohan, sorry.
No worries.
Yeah.
Hey guys, great paper. I was wondering if you could comment about what you might have to say about, in particular, the crisis period in your sample. A lot of the pictures and the narrative, it seemed to be, was about the secular trends over this 14 period. And could you maybe talk a bit about what your data says about what happened from 2007 to 2009?
So we haven't, so yeah, unfortunately, we haven't really done a full detailed analysis of this crisis period. The things that we have noticed just from what we've been trying to decompose the secular trend is that there was this giant shift again towards debt assets. Like this is like kind of like a flight to safety phenomenon, I think, during this crisis period. And the other thing that we kind of have a little bit of grasp on is that there was some sort of retrenchment in which investors kind of pulled money back, but we're not, we haven't fully fleshed that story out yet in our data. Ultimately, like, it seems that our data is just at a slightly too low of a frequency to get too much action here, right? Because like, if you want to think about crises, we have one observation at the end of 2007, one observation at the end of 2008. And like, it's a lot of that, I don't think, a lot of like the very, I think, very neat trends may not be fully captured by kind of these two observations. I guess we have an observation too. Anyways, the short answer is we can dig a bit deeper into that, but yeah, we haven't really done so yet.
Great. The next we have Madel asking a question.
Hey, Tony. So great presentation. I have a number of suggestions on sort of the data or how to sort of push it further, but those I'll reach out offline. But on the broad theme, one thing that I wanted to figure out is the nature of the counterfactual. In particular, I could think of two very different stories. One story is the central banks come in, they have a very inelastic demand for US debt, and through a portfolio sort of channel, the rest of the private investors shift to equity. It's just a portfolio rebalancing as that demand comes in.
Yeah.
The other one is instead almost the opposite. You could tell the story with the rest of the world wants to shift to equities, and that opens up a gap in the bond market, and the central banks fill it. And I'm trying to figure out, when you're doing the counterfactual, are we getting close to those stories and to distinguish them? That's not the right way to think about them. How do you want us to think about your counterfactuals?
I think the way that we've been thinking about it, you guys can correct me if I'm wrong, the way we've been thinking about it is the first story, where the central banks are kind of coming in, purchasing the debt assets, and then there's a direct portfolio rebalancing component from the investor side, where they rebalance towards equity markets. Now, the second yeah, it really is going to have to be, I think it really has to be that story so far with just our framework, because we are first just taking these kind of central bank holdings as purely exogenous shifts in the supply of the assets being available for purchase. We're not really saying anything about how those shifts may be changing investor expectations or anything like that at all. It's really just, they're just taking some assets away.
Yeah, and I guess a follow-up question from me, like, even if you zoom in the central bank holding alone, right? I see you use data from the IMF, which doesn't give you a very granular breakdown, and then you supplement that with the Fed holdings, but potentially you can dig deeper, right? A lot of central banks publish very detailed holdings, and there is sufficient amount of heterogeneity across them, like the S&P actually holds a lot of equities. So is there anything that you can potentially say about, like, what are the impacts, like, from a central bank perspective when diversifying into other non-risk-free asset class?
Yeah, I think you're exactly right that that's a direction that we want to go here. In particular, just getting a better sense of what the central banks are doing, right? Because we only have the disaggregated data, really. Well, we have the Fed's portfolio, and then we have all foreign reserves. And so it's fairly aggregated in that respect. So I think a next step to understand the central bank behavior better would be to disaggregate this, at least for the ECB. I think we can do it for Japan and some others, and potentially across things rather than just the total aggregated asset class. So I'm certainly on board with that.
Yeah, one more thing which we will dig into is there seems to be a tug of war between the US domestic quantitative easing, the Fed's buying the US bond, versus the foreign central banks accumulating reserves in dollar bonds. And in terms of their effects on the portfolio imbalances of the US, they may have offsetting effects. And this is also something we would like to know more about.
Great. So for now, we have a last question from Charles Engel. If you still have questions, please raise your hands. But otherwise, the last question goes to Charles.
Hi, are you able to hear me okay?
Yes.
Yes,
Hi, Charles.
Hi. So I'm, I got to admit, I haven't read the paper, and I was just trying to kind of flip through it while we're sitting here. So one thing I didn't quite, this is kind of a three-part question. I'll ask them all at once. I mean, I guess you didn't show us, but something that's in the paper is net issuances. So that was kind of confusing me during the presentation, but that you also allow for that. Am I right? And then, but then I guess it kind of two questions. I mean, normally, I mean, there's this question of whether we should think of these government bonds as being outside assets. So, I mean, it seems like in this framework, if the government issues bonds, it increases the wealth of everybody, and there's no kind of offsetting tax liability. And kind of a similar related question, I didn't quite understand what was going on with open market operations, because, when a central bank buys a bond, they're also creating an asset, and that seems to be an asset that you didn't have a demand function for. So I guess both of those things I'm wondering about, reserves or whatever this asset is they create, and also net tax liabilities. Is that just all like residual?
So I think some of this might be helpful to think about first, just to clarify what's going on with quantities. The quantity issuance is going to come in through the savings counterfactual, in the sense that we're increasing the quantity of assets along with the total investment. So we're thinking about savings essentially as the excess of savings with respect to how much assets there are out there to purchase. Okay, and for quantities, we're literally just like, there's a Q in the equations that you saw earlier. We're just increasing that Q. The reason we're kind of also doing this is, you also kind of think that, quantities are kind of endogenous to how much savings there is. There might be more issuances going on with more savings. So it's nicer, I think, for us to think about these things moving together. Okay.
I got that, but I mean, as I said, it seems like there's also a liability, net tax liability, and like I said, where are tax liabilities? So where are assets of money?
So okay, so that part of the question, the other components, so like what does this imply for the fiscal side of the economy? We've kind of just, we have nothing to say about that. So that would fall, basically, you can see that this, what we have here really is just a structural model of the capital markets by themselves. We don't have anything to say about what's more broadly going on with basically the productive side of the economy, or anything about taxes, government balance sheets, things like that. Of course, like basically, if we want to say something about that, we would have to build that in on top of this structural model. And that's how I think one would get to that kind of question, but we haven't done that yet. So correct me if I'm wrong, guys, but.
Can I add something? So Tony, could you go to the equation where we have the AUM dynamics? So Charles, there is a sense in which we do match assets with liabilities. Think, for example, about the US agent issuing additional debt. In that case, on the one hand, we see an increase in the net quantity of the US debt in the debt market. So that is the liability side. On the other hand, the US agent should have collected the proceeds from the issuance, and that could show up as an inflow into the total wealth of that agent. So in equation 5, you can think of the flows term F as being consistent of the flows due to new issuance and additional flows due to, say, additional savings from.
Well, again, I'm just concentrating on two specific things, which are government issuance of debt, for which there is no counterparty in the data here. The counterpart would be future tax liabilities. And the second thing is money, our reserve holdings. So when you make a open market purchase, you're buying an asset, but creating, you're buying an asset, but creating a liability. And I don't see money as something here as well. And I'm not trying to be critical. I'm actually just trying to do the accounting in my head. But
yeah.
So as I understand it, those things are not in here, and that's fine. I'm just trying to.
Yeah, no, you're absolutely right. So like as Zhang Yang was briefly trying to mention, is like you could think about this F. This F we're currently taking it as exogenous, right? But we can build. So to do this counting exercise properly, to fully spread out like what is the what is when you issue a bond, where does that money go on the other side of the balance sheet? We could build that into the F. But as you can see from this equation 5, we haven't done that yet. So you're absolutely right in your statement of saying it's kind of like the residual component right now in the model.
Yeah. Okay. That's that. I think I got it. I'm just trying.
Yeah, okay,
like
good.
I said, I was a little bit behind.
Yeah.
I was trying to catch up here.
No. It's absolutely right. Yeah.
All right. If there are no further questions, I guess we'll just pause here and thank you very much for the wonderful presentation and all your participation. Have a great holiday season and we'll all see you back in mid-February.
Thank you.
Thank you.
Thanks, everyone.